Before you buy any crypto token, you need to ask yourself one critical question. Who really owns the supply? Because let's be honest, in the world of crypto, price doesn't just move based on belief or cool technology. It moves based on who is allowed to sell. And when they're allowed to sell it, understanding this simple fact can be the difference between a great investment and a total disaster. Today, we're diving deep into two of the most important concepts in crypto investing: token, distribution, and vesting schedules. Together, they reveal who holds the power, who has the biggest profit advantage, and most importantly, who is carrying the most risk. For any serious investor, this isn't just optional information, it's absolutely non-negotiable. So, let's start with token distribution. This simply explains how a project's tokens are allocated when it first launches. Think of it like a pie chart. Most crypto projects slice up their tokens among several key groups. You'll typically see allocations for the founders, the core team, for early private investors and venture capital firms, for advisors, for community and ecosystem rewards, and of course for the public sale where retail investors like us get to buy in. On the surface, a distribution might look balanced. Maybe 20% for the team, 20% for investors, 40% for the community. Seems fair, right? But here's where you have to look closer, because the details matter far more than the headline percentages. The biggest secret is that early investors, the VCs and private sale participants, almost always buy their tokens at a massive discount. Their entry price might be cents on the dollar compared to what you pay during a public launch. This means even a small increase in the token's price can translate into enormous profits for them. And what do people do when they have massive profits? They sell. This creates huge selling pressure on the market. If these early investors hold a large chunk of the supply, they effectively control the token's liquidity. They can influence the price direction, and guess who's often left absorbing their exit? That's right, retail investors who bought in at higher prices. Good tokenomics helps you spot this imbalance before you invest. Now, let's talk about the second piece of the puzzle: vesting. If distribution tells you who gets the tokens, vesting tells you when they can actually sell them. Vesting is the timeline of risk. When a project launches, many tokens, especially those given to the team and early investors, are locked. They can't be sold immediately. They might be locked for several months or even years, then released gradually over time, or sometimes unlocked all at once in a big chunk. These large unlock events are something every smart investor tracks obsessively. Why? Because when a huge amount of new supply suddenly hits the market, it often leads to a sharp price drop. The market gets flooded, volatility spikes, and it can trigger panic selling among other holders. There are two main types of vesting schedules you need to know. The first is a cliff. A cliff means all the tokens for a certain group unlock at once, after a fixed period, like 6 months or a year after launch. Imagine millions of new tokens suddenly becoming sellable on a single day. That's a high-risk event. The second type is gradual or linear vesting. This is where tokens unlock slowly over a longer period, like a small percentage every month for 2 or 3 years. From an investor's perspective, gradual unlocks are almost always healthier for a project. They prevent sudden supply shocks and create a more stable market environment. So when you're looking at a vesting schedule, always check: how big is the cliff? Who is receiving the tokens? And is there enough market demand to absorb that new supply without crashing the price? Let's be real about the advantages that founders and early investors have. It's not just a level playing field. They get in at much lower prices. They have access to better information directly from the team, and they usually have a much longer time horizon to wait for their investment to pay off. Retail investors typically enter the game much later, often drawn in by hype cycles when prices are already high. This doesn't mean you can't make a profit. Of course, you can. But it does mean you have to be smart and understand exactly who you are competing against. By analyzing the tokenomics, you can figure out if the project's incentives are aligned with yours as a long-term holder, or if the whole system is stacked against you from the start. Now, many projects love to advertise a large community allocation. It sounds great, right? A project for the people. But again, you have to dig deeper and ask the right questions. When does this community allocation unlock? Is it unlocked right away, creating immediate sell pressure? Who actually controls these community funds? Is it a decentralized organization, a DAO, or is it secretly controlled by the core team? And does the distribution method actually reward long-term participation and value creation, or does it just encourage quick flips? If community tokens are dumped onto the market too quickly, they don't build value. They just become more selling pressure. Ashcon investor, you need to be on the lookout for some major red flags. Be very cautious. If you see an extremely high 40 or 50% going to venture capital firms or the team, be wary of very short vesting periods, like anything less than a year. Watch out for large, early unlocks scheduled just a few months after launch. And, of course, a complete lack of transparency about who owns what. It's the biggest red flag of all. If a project won't show you its distribution and vesting schedules, you should probably run the other way. These things don't automatically guarantee a project will fail, but they dramatically increase the risk for you, the retail investor. On the flip side, what does a healthy token distribution look like? Generally, you want to see a reasonable team allocation that's vested over a long period, like 3 or 4 years. This shows the team is committed for the long haul. You want to see clear incentive structures that reward users for actually using the platform, not just for speculating. And you want to see fair community rewards that are distributed thoughtfully over time. Projects with these characteristics tend to retain their users, experience less volatility, and ultimately reward their long-term holders. Remember, analyzing tokenomics isn't about trying to avoid all risk. Investing is inherently risky. It's about understanding the risk you're taking on. One of the most common mistakes I see beginners make is saying, "Oh, this is a great long-term project, so I'll just buy and hold forever." But if the vesting schedule is constantly unlocking new supply, and insiders are continuously selling their discounted tokens, your long-term hold can quickly turn into a long-term loss. You must align your own investment timeline with the token's vesting schedule. So, understanding token distribution and vesting protects you from the hidden risks that aren't obvious on the surface. It helps you see beyond the hype. In our next video, part 6 of this series, we're going to shift our focus to token utility and how to determine a token's real value. We'll answer questions like, what actually gives a token its fundamental value? Why do some tokens have a lot of users but still see their price go down? And how should you, as an investor, properly evaluate real, sustainable utility? This is where the hype from marketing collides with the hard reality of fundamentals. Thanks for watching. Make sure you subscribe and hit that notification bell so you and miss the next part of our journey to becoming a smarter crypto investor. See you in the next one.